Dear friends, we shall now do chapter 11 of the course claims. You can expect 4 questions from this chapter in the examination. Because it's an important chapter, there will be as many as 4 questions from this chapter. What are the learning objectives? What are we supposed to learn from this chapter? We have to learn what is a claim. What is a claim in life insurance? And what are the different types of claims? And what are the requirements of a valid claim? And we have to recognize invalid claims. We cannot afford to pay them. And what are the documents required to be submitted to settle a death claim? And what are early death claims? What is the process of settling maturity, survival and death claims? And what are the IRDA guidelines pertaining to the settlement of claims? Consequences of settling a fraudulent claim. If you pay a fake claim, a fraudulent claim, there are serious consequences both for the insurer, the insured and the person who is doing the fraud also. What are they? Distinguish between contracts that are void and voidable contracts. There are void contracts and voidable contracts. What are they? Lastly, what is this indisputability clause in life insurance policy? Section 45 of the Insurance Act 1938, it deals about the indisputability clause. What is it? We are going to study towards the end of the class. Now, what is a claim? A life insurance contract is often referred to as a set of reciprocal promises. The insurer or the insurance company makes a promise and the insured person makes a promise. The insured person promises to pay the premiums regularly every year, every half year, every quarter or every month. And the life insurance company or the insurer promises to pay the sum assured on the happening of a specified event. It may be the death of the policy holder or it may be the maturity of the policy that he has promised to make the payment on the happening of a specified event. At the claim stage, the policy holder has already performed his part of the promise and it is for the insurance company to perform its part of the promise. So, a claim is a demand that the insurer redeem the promise made in the contract. The insurer at the time of issuing the policy, he promised that he would make a payment on the happening of a certain event. Now the time has come for him to redeem his promise. He has to pay the amount as promised. The insurer then has to perform its part of the contract, that is settle the claim after satisfying itself that all the conditions and requirements for the settlement of the claim have been complied with. Promptly paying is one thing, but you cannot afford to pay a false claim. So before making the payment, you have to make sure that all is okay, that the event insured has happened, that all the premiums have been paid regularly and all the papers necessary for settling the claim have been received. So, punctually paying the claim is also important. At the same time, avoiding false claims payment also we should take care of. This is the next question. Then, what are the different types of claims? 1. Maturity claims, 2. Death claims, 3. Rider benefits. So, these are the 3 types of claims payable by a life insurance company. First, maturity claims. What is a maturity claim? Some life insurance plans such as endowment plans and whole life plans promise to pay the insured a specific amount at the end of a plan if they survive the plan's entire term. This amount is known as the maturity benefit amount or the maturity claim amount. The amount payable on maturity is the sum assured plus any accumulated bonuses minus any outstanding premiums and interest thereon. If there is a loan on the policy, the loan together with the interest on loan will have to be deducted from the maturity claim payment. In some cases, the premiums are paid over the tenure of the plan or returned on maturity. Normally, under a term assurance policy, on maturity, no payment is made. Under a pure term assurance policy, in case the customer dies during the term, the sum assured is paid. But if he survives the term, no payment is made. But there are plans which promise that in case there is no death claim, the premiums paid would be refunded on maturity. So, such plans are called return of premium plans or ROP plans. Under those policies, you have to return the premiums and that is just like paying the maturity amount. Then, what types of claims come under maturity claims? Survival benefit payments. What are survival benefit payments? Under an endowment policy, sum assured is paid at the end of the term or on prior death. But under a money back policy, specified amounts are paid at certain intervals, say every 5 years. If it is a policy for 25,000 or 1 lakh, if it is a policy for 1 lakh, they may pay some 20,000 rupees after 5 years. And again 20,000 rupees after another 5 years. Like that they may go on making payments at certain intervals, be it 5 years or 4 years. And the last payment will be the maturity claim payment. So along with the last interval, last installment, we also pay the bonuses. Because when releasing the earlier installments, no bonus was taken into account. Just a certain percentage of the sum assured was paid to the policyholder. Then reduced sum assured or paid up value. If the policy premium has not been paid, the policy lapses and the contract is off. The policyholder is not entitled to the full sum assured payment. But if he has paid for a fixed number of years, say some 3 years, the policy acquires paid up value and a proportionate amount is paid on maturity. For example, it is a 1 lakh policy for 20 years. He paid for 10 years and stopped. Because he paid half the premiums, we will pay him half the sum assured together with the bonuses on the date of maturity of the policy. This is called a reduced sum assured payment or a paid up value payment. Then we have discounted claims. What are discounted claims? If you surrender the policy during the last year, it is called a discounted claim. The loss will not be as much as in the case of a surrender value. Surrendering a policy is always at a loss and it's not admissible. But when you want to cancel the policy during the last year, it may not be much of a loss because they calculate the amount payable on maturity and discount it by a certain percent, say 8%. 100 rupees today becomes 108 after 1 year. If 108 is payable after 1 year, 100 rupees is payable now. Like that there are some factors, they multiply the amount and pay it to you. This is what is called a discounted claim payment. Also, supposing an annuity is about to vest and I decide that I don't require so much of pension, or rather I require some amount urgently now. So 1/3 of the amount paid I can withdraw and ask the company to purchase an annuity for the rest of the amount. The purchase price has already been paid by me, the annuity is about to vest, so I tell them before the policy vests, I want to withdraw part of the purchase price I have already paid. Say 1/3 I will be withdrawing, 2/3 of the amount you purchase an annuity for me. To that extent, I will be receiving the annuity payments or pension payments. What is a death claim? Death claim on the happening of the death of the life assured. The life assured may be the policy holder, or if the policy is on the life of another person, the life assured and the policy holder may be different. So on the death of the life assured, payment is made to the policy holder or to the nominee or to the assignee or to the legal heirs. That is the death claim. On the happening of the death, in case the life assured dies, the sum assured along with the bonuses is paid to the nominee or assignee or to the policy holder if he is not the life assured. If a person takes a policy on the life of his wife, he is the policy holder, she is the life assured. On her death, they pay the sum assured to him. So this is about a death claim. Then rider benefits are also paid. What is a rider? A rider is an additional benefit under a policy. The most common rider is the accidental death benefit. In case the person dies because of an accident, what is exactly an accident is already defined in the policy. So in case he dies because of an accident, an amount equal to the sum assured also is paid to him as a rider. It is paid along with the sum assured itself. So no separate payment need to be made. A payment under a rider is made by the insurance company on the occurrence of a specified event according to the rider terms and conditions. Accidental death benefit ADB, critical illness rider is there. Health insurance is something different. Health insurance is a separate insurance where they reimburse the hospital bills and all these things. When you are taking an ordinary policy like an endowment policy, you can opt for a rider of critical illnesses. Some illnesses are named. If you contract the disease, if it has been diagnosed to be that disease, a certain amount is paid to you. Full hospital bills are not paid to you, but a certain payment is made to you in case the disease has been diagnosed to be one of the critical illnesses mentioned under the policy. And these may vary from company to company also. And some riders are for hospital care. Hospital care means fixed amount we cannot pay. He has to get admitted into the hospital first, and when the bill comes, we will reimburse the amount to him. He has to pay the bill and submit the bill to us for reimbursement. We will pay the policy holder the amount of the bill he has paid. So this relates to rider benefit payments. We have been saying that only valid claims will have to be paid. What is a valid claim? Once an insurance company receives notification of a claim, it will want to be sure that the claim is valid before it makes a payment. It will do this by checking the following. Once an insurance company receives notification of a claim, it will want to be sure that the claim is valid before it makes a payment. Was the insurance policy in force when the event occurred? When the date of maturity came or when the person died? Was the insurance policy in force? Means, were all the premiums paid? If a premium is not paid on or before the due date, or at least within the days of grace, a policy will lapse. So you have to make sure that all the payments have been regularly paid. Has the insured event taken place? Suppose the payment is payable on death. Has he really died? We want proof. We want proof of the event. For a maturity claim, we don't want any proof of event because we know that the maturity date has come. The insurer, as a party to the contract, he knows when the policy is going to mature. So in this case, proof of event is not necessary. Then, have the original policy document, a completed claim form and all other required documents been submitted. Whenever the policy is to be paid, the policy document will have to be submitted because the contract has come to the end. The policy will have to be cancelled after the payment is made. So the company always insists on the policy document being submitted along with a demand for the payment of claim amount. And a claim form, generally a number of forms are submitted to the claimant. He has to fill them in and submit. And one of the most important of the forms is the claim form. Has it been duly filled in and submitted? And all other required documents, for example, if it is a death claim, there should be proof of death. And other requirements are there as we are going to see. So have all the papers been received intact? Then only we can call it a valid claim. Why a claim may be invalid? We have been talking about valid claims. What are invalid claims? What is wrong in an invalid claim? The policy is not in force. The policy holder has not paid all the premiums which have fallen due in time. So the policy has lapsed. The policy is not in force. If we cannot pay the claim, it is an invalid claim. Number 2, excluded conditions apply. When issuing the policy, there is a clause in the policy document, suicide clause. If the customer commits suicide during the first year of the policy, claim amount will not be paid. So if he has committed suicide, done something which is excluded, so we cannot pay the claim. Lastly, the claim is fraudulent. The person is wrongly claiming the amount. Probably he did not mention all the facts relating to health and all that correctly while submitting the proposal. So there is some fraud. What it is, we have to exactly identify. So because of these reasons, it may be a fraudulent claim or an invalid claim. Invalid claim is policy is not in force because premiums have not been paid. Secondly, there is an excluded condition. We are not going to make the payment if this event happens, that is suicide during the first year. He has committed suicide during the first year, which is excluded. We need not pay. Lastly, the claim is fraudulent. Either the wrong person is claiming or at the time of proposal some cheating has been there. So what the fraud is, we are supposed to find out and take care of it. Duties after death and documentary evidence. Supposing somebody has intimated to us that a certain policyholder has died or the life assured has died. What are the papers we are supposed to call for? Because we have to thoroughly make sure that the event insured has happened. Only then we can pay. The policy document. The policy document is the evidence of the contract. So when he is claiming the amount, he has to submit the policy document for cancellation. Suppose the policy is lost. What do we do? If the policy is lost, we ask him to execute an indemnity bond. He has to execute a bond, often along with a surety, that the policy is really lost and lost beyond recovery. So please make the payment of claim without the policy document. In case the policy is traced somewhere and somebody makes misuse of it and the company incurs loss, I will make good the loss to the company. If there is any loss to the company because of the lost policy document, I undertake to make good your loss, indemnify your loss. He has to execute an indemnity bond along with a surety, and sometimes we also ask for an ad, an advertisement to be published in the papers. Such and such a person has informed to us that the policy document is lost, so we are going to make the payment without the policy document. Our suspicion is that it is not really lost. He has already assigned it to a bank for loan. So it is with the bank, and he tells us that the policy document has been lost. So we have to give a paper advertisement, and after waiting for 30 days, we take action. We make the payment. Deeds of assignments, reassignment. Suppose a policy can be assigned to a bank for a loan or for an overdraft. So if the policy is assigned to the bank, bank becomes the policy holder. The title of the policy holder in the policy has passed on to the bank. So we cannot pay to the policy holder. Sometimes after the repayment of the loan, the bank reassigns the policy to the policy holder. Then policy holder once again becomes the owner of the policy. So if he is claiming the maturity proceeds, he has to submit the assignment papers and the reassignment papers to establish that he is the policy holder and that the title to the policy has reverted to him. Proof of age, if not produced earlier, most cases along with the proposal we are seeking age proof. So 99.9% policies, we need not worry about the proof of age at the claim stage. But in case he has not submitted proof of age at the time of taking the policy, at the claim stage we have to ask for the age proof. Because without obtaining 3 proofs, we cannot pay any claim. Proof of age, proof of event, and proof of title. So we have to call for age proof also in case it is necessary. Then the death certificate. If a person died, we have to call for the death certificate from the municipal records or some such thing. Then the claimant's statement. Generally, a claimant is asked to fill in a form and submit. In all claim cases, be it an early claim or a non-early claim, a claim form is a must. And we compare the information given in the claim form to the proposal form to see if there is any misstatement or any suppression of fact. So the claim form has been received or not, we have to make sure. Then legal evidence of title. Normally we make the payment of the policy monies to the nominee if there is a nominee. Or if there is an assignment, we pay to the assignee. But in some cases, no nomination has been made. So to whom can we pay? We can pay to the legal heirs. And who the legal heirs are, the court will have to decide. So we advise him to approach a court for a succession certificate. So the succession certificate is received, he has to submit it to us and we pay the legal heirs accordingly. Lastly, the discharge form, sort of a receipt for the amounts. We are going to pay him, so we seek an advance receipt that he has received the amount by check and all that, and the discharge also has to come to us. The policy document has to come to us, the discharge has to come to us, then we are ready to make the maturity claim payment or the death claim payment. Next subject we are going to examine is early death claims. What are early death claims? If a policy becomes a claim by death, if a policy holder dies within 3 years of the date of commencement, if he dies within 3 years of the risk rate, we treat it as an early claim. Require more forms to make sure that all is okay. Okay, a policy was taken, it lapsed due to non-payment of premiums after some 6 years. And he got the policy revived. If the policy has been revived, it is a fresh contract. So if a policy has been received, if he dies within 3 years of effecting revival, we again treat it as an early death claim. So if the policy has resulted in a claim by death within 3 years of the date of risk or the date of revival, we treat it as an early claim and we call for more forms and we make sure that there is no fraud. We make sure that all is okay regarding the policy. If the claim occurs within 3 years from the date of risk or from its revival, insurance companies normally classify it as an early death claim. If the life insured had an unnatural death, such as an accident by suicide or by an unknown cause, the following will also be looked into. If he mentions that he died by an accident, we are not going to take his statement as final. we want some extra proofs. Where it is not a natural death, where a person dies because of an accident, we call for certain papers, extra papers. Number one, police first information report. From the police department, we have to get the FIR or the first information report. Secondly, we want the Panchanama, the report of the Panchanama or the inquest. We also call it a coroner's report. In some cities there are coroners. So where there is a coroner in cities like Bombay, a coroner's report, or if it is a smaller place, the Panchanama report or the inquest report is adequate. Then the forensic report, lastly post-mortem report. All these reports are called for. Because just because he says that he died by an accident, we are not going to pay the double the sum assured to the nominee. We want to make sure that an accident really took place. Only then we are going to make the payment of the claim. Settling claims. IRDA, as we know, has been controlling the life insurance companies. It has been regulating the working of the life insurance companies. And it has been taking the side of the policy holder. Policy holder should not be delayed. Policy holder's requirements cannot be delayed. He should get his due in time. So, they have issued some guidelines for claims. What are the guidelines? Number one, claim requirements should be mentioned in the policy document. When issuing the policy document, you have to make a specific mention in the policy what requirements you will be seeking to pay the claim. So, at the time of issuing the policy itself, they have to state, we shall be making the payment of claim only on the receipt of these requirements. And you cannot subsequently say we want something more and all these things. Then within 15 days of death intimation, all the necessary forms should be sent in one go and not piecemeal. Until the death intimation comes, the insurance company cannot initiate any action. In the case of a maturity claim, we don't want any initiation by the policy holder because the company knows that the policy has matured. The company will initiate the maturity claim payment action. But in the case of a death claim, unless we get an intimation from the policy holder, we don't know that we have to take action. So when intimation has come, within 15 days we have to write to him what are the requirements we require to pay a claim. And you cannot go on adding requirements. We want these things also, those things also, like that. In one go, you have to mention to them, we want these requirements, upon receipt of which we are in a position to pay the claim. Within 15 days of death intimation, all the necessary forms should be sent in one go and not piecemeal. Next, claim should be paid within 30 days of receipt of all requirements. If the insurer wants to repudiate the claim, the decision has to be communicated within 30 days. Okay, we have sent the forms, they have filled in and returned to us. After all the papers have been received, within 30 days you have to make the claim payment. Supposing you trace that, you find out that there is something wrong, you need not pay. It is a fraudulent claim. You want to repudiate the payment. You don't want to pay the claim. Even that fact you have to inform within 30 days of receiving all the requirements. So within 30 days of receiving all the requirements, you either pay the claim or repudiate the claim. You cannot expect the policy holder to wait indefinitely for your decision. Then, in case of delayed payments, interest of 2% about bank rate should be paid to the claimant. Suppose the company was not able to pay within 30 days. They have taken 2 months' time to make the payment. They have delayed the claim payment by 1 month. For that 1 month, for the claim amount, you have to pay interest. At what rate? Reserve Bank often fixes the bank rate from time to time. You have to pay interest 2% about the bank rate. If the bank rate is 5.2, you have to pay interest at 5.2 plus 2. 7.2% interest you have to pay to the claimant. In case the delay is due to the inability of the claimant to submit the requirements, interest requirements, interest at the rate allowed in savings bank account should be paid. Supposing the company is not at fault for the delay because the customer took a long time to submit the papers back, or there is no nomination and they have gone to the court to get the succession certificate, that is taking time. We are not responsible for the delay. Even there, we are supposed to pay interest at the bank rate. Bank rate means at the rate at which scheduled banks pay to their savings bank account holders, not fixed deposit account holders. Savings accounts, some 3.5% or 4% interest is paid. So at that rate, we have to pay the claim. Because the amount has been with you. It is true that you are not responsible for the delay. but the amount has been with you, so you have to pay at least that savings bank interest rate to the customer along with the regular amount. Now, we shall examine what is a maturity claim. What is a maturity claim? Or rather, what kind of payments come under this head? What kind of payments they come under the head? Maturity claim. Number one, maturity claim. Where a policy has matured, we pay the maturity claim. Number two, survival benefit payments. We have already seen that under a money back policy, certain payments are made at certain intervals. Say every 5 years, some 1/4 of the amount or 1/5 of the sum assured is paid to the policyholder. This also comes under maturity payments. Then paid up valid claim. Paid up claims. Paid up claims means if the customer was not able to pay all the premiums, at least if you pay premiums at least for 3 years, the policy will acquire a paid up value and a proportionate sum assured is paid to the policyholder. This paid up value payment also comes under maturity claim payments. Then discounted claims. We have already seen that if the customer wants to surrender the policy during the last year, it is called a discounted claim. It is not such a big loss as a surrender payment. We calculate the amount payable on maturity and we discount the amount at a certain rate of interest. 100 rupees becomes 108 after 1 year. So if we have to pay 108 after 1 year, we have to pay 100 rupees now. 100 rupees is the present value of 108 rupees. Like that we calculate and pay him a lesser amount. Then commutation of installments. We have already seen where an annuity is about to vest. We can withdraw part of the purchase price so that some lump sum amount is paid back to you and the balance is used to purchase an annuity. So actually we are commuting a certain percentage of the annuity installments. This also comes under a maturity claim. Annuity payments at the time of vesting. After the annuity has vested, we have to start making regular payments. Every year, every half year, every quarter or every month. And these also come under maturity claim payments. Then what is a fraudulent claim? We have been speaking about people who commit fraud. Insurance fraud is a deliberate attempt to use insurance for unjustified financial gain. Insurance fraud includes bogus claims and the misrepresentation of facts. Fraud in claims may be a bogus claim. He has not died, but they are seeking the death claim amount. They did not represent the facts clearly when applying for life insurance. When submitting the proposal, certain misstatements were made, certain facts were suppressed. This also comes under a fraudulent claim. What are the consequences of fraud? Fraud is a serious offense and its consequences are far-reaching. Number one, what are the consequences of fraud for the insurer? Insurer is unnecessarily paying a claim. He is paying something which he need not. So, premium payment he has been received is not adequate to arrange the payment. So, he loses. So, he has actually resort to increasing the premiums. Now, we have competition in the insurance industry. So many companies are there. So, if you enhance the insurance premium, you are going to lose in the competition. So, it is a loss to the insurer. Consequences of fraud for the insured. And how does the policyholder lose? If the company increases the premiums, you are supposed to pay a higher premium. In this way, the policyholder also will lose. And what are the consequences of fraud for the fraudulent claimant? Fraudulent claims are paid means more and more fraudulent claims will be there. The person who is paying fraud will go on doing it again and again and frauds will increase. So, paying of fraudulent claims is a loss to all the parties concerned. This should be very carefully watched and no fraudulent claim should be paid. Next subject is presumption of death. Now, we were talking about the death certificate. You cannot pay any death claim without a death certificate. Without getting the certificate, how you can pay the claim? But in some cases, people are missing. When people are missing, you cannot say they are dead. How to pay the claim when a person is missing? You cannot say he is dead. He may be somewhere. So what to do about such cases? Proof of death is essential for a claim to be settled. However, sometimes a person is reported missing without any information about their whereabouts. He might have gone away from the house because he is not happy in the house. You cannot say he died just because he disappeared. So what to do? Section 107 and 108 of the Indian Evidence Act 1872, they deal with the presumption of death. Under this act, if an individual has not been heard of for 7 years, they are presumed to be dead. So what we do is, if a person is not seen or heard of for 7 years, we can presume that he is dead. Normally, the legal heirs of the person, they have to continue paying the premiums regularly, because if you don't pay the premiums, the policy will lapse, and they have to inform the matter of missing to the police, and subsequently they have to wait for 7 years. After 7 years, they have to approach the competent court, and the court will examine all the people concerned, and they say, we can presume that the person is dead. They cannot say that the person is dead, because he has not been seen or heard of for 7 years. We can presume that the person is dead. After the order comes, we can make the claim payment, and no problem if he turns up afterwards, because we have gone through the legal process. In some cases, actually taking the facts into consideration, the company itself may pay the claim. They may not insist that the person should go to a court of law. If they are satisfied with all the details given by the legal heirs, they say, okay, we will pay the claim. You don't need to go to the competent court. Their order, their decree regarding presumption of death. I said just now that all the 7 years they have to pay the premiums, because if you don't pay the premium, the policy will lapse. So to keep the policy alive, they have to go on paying all premiums all 7 years. But this also, in some cases, the company can waive if it is satisfied that it is a genuine case. Then there are two types of contracts: void contracts and voidable contracts. What are void contracts and what are voidable contracts? If a contract is void, it has no legal effect. The contract is not there. If you enter into a contract with a minor, it is a void contract, because only majors can enter into a contract. If you enter into a contract with a mental patient, it is void. It has no legal effect at all, because there are some essentials for a contract. All the essentials will have to be satisfied. Only then it is a valid contract. So if any of these essentials has not been observed, or if any of the essentials have been violated, it becomes a void contract. It is of no legal effect. The contract is cancelled. There are voidable contracts. Voidable means they are not void. Supposing the customer did not mention an important point in the proposal, he suppressed a fact, but the fact is not very serious. It is not a material fact, and the company may overlook it. If the company wants to cancel the policy, they can cancel it. It is voidable, means it can be made void by the company, but the company waived that. It's not a serious suppression, and the fact suppressed is not a material fact. So they can go ahead with the contract. It is a voidable contract. A voidable contract can be made void at the option of one of the parties, normally the insurer. So void contracts, they are of no legal effect at all. Lastly, indisputability. What is this indisputability? Now, if any misstatement is there, of any suppression of fact is there, the company can always cancel the policy. And customers were afraid. Supposing by mistake I mentioned something wrongly, after I pay all the premiums, the company may say, you mentioned that fact wrongly, I am going to cancel the whole contract. So people were afraid, and to allay their fears, this section 45 has been introduced in the Insurance Act 1938. Section 45, which deals with indisputability, says, after 2 years are over from the risk rate, the company cannot cancel the policy just because a certain point was not correctly mentioned. During the first years, they can cancel the policy if the slightest misstatement is there or the slightest suppression of fact is there. But after 2 years, even then they can cancel the policy after 2 years, but 3 conditions will have to be satisfied. Number 1, there should be a suppression of fact, and that should be regarding a material fact. Suppose he has suppressed a minor thing, that's not very serious, but he suppressed a disease, that is a material fact. A material fact is one which has a bearing on the risk. So it has to be a material fact, and the company has also to prove that it was not a mistake but mischief. Deliberately suppressed that fact. It was not an omission but a deliberate suppression. It's not easy to prove fraud. So after 2 years, customers can rest assured that their policy will not be cancelled. So this is section 45 of the 1938 Insurance Act, which has been passed to take care of the interests of innocent policyholders. And this prevents the insurance companies from taking undue influence on the customers, prevents the companies from unnecessarily penalizing the policy holders. This is section 45, indisputability. We shall see some questions and answers. First question. Ranjan took out a 20-year money-back plan on his own life 5 years ago. Survival benefit was due on 4th May. Ranjan died on 6th May without receiving the survival benefit payment. What will be the legitimate procedure to pay out the claim? The options are: survival claim will not be paid and only death claim will be paid to the nominee. Both the survival claim and death claim will be paid to the nominee. Survival claim will be paid to the legal heirs and the death claim to the nominee. Both the claims will be paid to the legal heirs. Here, on 4th May, the survival benefit payment has become payable and he was alive on that day. So it is to be paid to him but not to the nominee. Unfortunately, he died. So this payment will be made to the legal heirs. And because he died, a death claim payment also will have to be made. That is the remaining installments under the policy and also the sum assured or the sum assured deducting the installments already paid along with the bonuses will have to be paid to the nominee. So the right answer is the third option. Survival claim will be paid to the legal heirs and the death claim will be paid to the nominee. This is the answer. The next question is, what is the maximum time in which the insurer should settle a claim when all documents are submitted? He is talking about the IRDA's guidelines. IRDA has issued some guidelines which all the insurance companies will have to follow in toto. When all the documents are submitted, within 30 days the claim will have to be paid. So the third option, 30 days is correct. After the receipt of all the requirements for payment of the claim, within 30 days he has to pay the claim, or if he chooses to repudiate the claim, he has to repudiate within 30 days only. Within 30 days, the customer should get a no or an yes. A missing person is considered to be dead after 5 years or 8 years or 12 years or 7 years. According to sections 107 and 108 of the Indian Evidence Act 1872, if a person is missing for 7 years, he will be presumed to be dead by the competent court of law. So 7 years is the right option. The delay in settling claims by any insurance company as per IRDA norms has to pay is -% if the present bank interest rate is 5.2%. If the insurance company delays the payment of any claim amount, they have to pay at the rate of 2% over and above the bank rate of the Reserve Bank of India. He says that the bank rate is 5.2% plus 2. 7.2% is the right answer. He has to pay interest at the rate of 7.2%. Then, an indemnity bond was signed in a policy when the claim was paid. This indicates that the policy was lost, it was paid up, it was lapsed, it was surrendered. It was lost. The policy document will have to be submitted for any claim. Unfortunately, our policyholder lost the policy document. The procedure in such cases is he has to execute an indemnity bond saying that in case the policy is subsequently traced and misused by somebody and the insurance company incurs any loss, that loss will be made good by the policy holder and the surety also. So, it was lost. Only when a policy is lost that the company calls for an indemnity bond along with a surety. Detailed investigation will be triggered in case of maturity claims, all death claims, early death claims, rider benefit claims. For all claims, we don't want any investigation. Only in the case of early claims, early death claims means the person died within 3 years of issue of the policy, or rather within 3 years from the risk date, or the date of commencement of risk. Or if a policy becomes a claim within 3 years for revival also, it will be treated to be an early death claim because revival amounts to a fresh contract. And we just want to make sure if he has made some false submissions in order to get the policy revived. So, early death claim is the right answer. What key event is most likely to make an insurance contract not a valid contract? When does a contract become an invalid contract? The circumstances are legitimate. There is no illegitimate thing. Representation of facts by the policy holders is true. Nothing wrong. The life assured is a major, no problem at all. There is no insurable interest attached to the policy. The policy has no insurable interest. Insurable interest means their right to insure. Any person can take a policy on his own life, no problem at all. But if he wants to take a policy on the life of another person, there should be insurable interest present in the policy. Means he should have the right to insure. Any person has a right to take a policy on the life of his spouse and also some other cases. So, if the insurable interest is not lacking there, without insurable interest, it is not a regular life insurance policy and it's not a valid contract. Next question. According to IRDA guidelines, how long does an insurance company have to complete its investigation of a claim? Wherever there is an early claim, that is to say, when a death claim has arisen within 2 years of the risk date or within 2 years after the date of revival, the insurance company has the right to cause an investigation and make sure that all the submissions were correctly made, there are no misstatements, there are no suppression of facts and all that. But what time can they take? We have already seen that whenever the papers are submitted, the insurance company has to make the payment within 30 days. But where there is an investigation, they can take time of 6 months. So 30 days, no, 90 days, no, 120 days, no, 180 days. So if there is an investigation, within 180 days of receiving the requirements, they can make the payment. So these are the questions and thank you.